A good decision is based on knowledge and not on numbers. Who knew Plato was a retirement philosopher? But the quality of your decisions is really going to be a big determinant of your retirement, and that's why we're going to cover decision making this entire month on the Retirement Answer Man Show. Welcome to the show. My name is Roger Whitney. I'm so excited you're here. It's a big topic. Now, this is the show dedicated to helping you not just survive retirement, but rock retirement. Make this the best phase of your life through intentional decision making. And every month on the show, we bring up different topics and talk about how to make decisions on those topics. So it made sense, and I don't know why we didn't do this previously. Shouldn't we talk about how do we make better quality decisions or higher quality decisions? Because if we can do that consistently, that will change the trajectory of your life in some pretty amazing ways. So this entire month, we're going to explore how do we make better decisions, and hopefully at the end of this month-long exploration, come to a framework that we can apply to make better decisions more consistently. But first, before we do all that, let's get to a word from our sponsor. So when you're planning out your retirement project, there are a lot of decisions to make. And what we did in the Retirement Masterclass series within the Rock Retirement Club is build a masterclass that is built around the agile methodology of taking each incremental step, one step at a time, and teaching you how to do it and giving you tools and support to make that decision and then move on and on. And then what you would get at the end of it is a framework for how much can I spend in retirement? How should I approach retirement spending? What am I going to be doing in retirement? So if you're interested in a master course that helps you frame your decision making and a community around it that supports you in making better decisions, check out rockretirementclub.com. Now, what is a decision anyway?
Huh? What does that mean?
Decision, a conclusion or resolution reached after consideration. So the decision is the result of a process. You consider the trade-offs, your preferences, your resources, and then when you make the decision, that's the resolution. It's the result, and it's essentially your prediction of what you think will serve you best. And what ends up happening a lot of times is we evaluate our decisions based on the outcome. If it worked, it was good. If it didn't work, it was bad. And we're going to explore whether that's really a good way of doing that this month. And even in 2 months ago, when we were exploring behavioral finance, Dr. Daniel Crosby in the club, one of his quotes, and it's from his book, The Behavioral Investor, was, better decisions usually happen by valuing the process more than the result. Because if you have a good process, even if the result doesn't work out, you know you've considered everything in a logical way, and a bad or good decision can help inform you how to improve your process. And a lot of us don't approach it that way. And as we build this framework throughout the month, I think we need to. We need to figure out how do we process things to make better decisions for ourselves, because that, I think, will improve the quality. So let's go explore on a broad level the decisions we got to make in retirement and why this is such an issue. The other day, I had to go to the grocery store to buy toothpaste. Have you ever been in the toothpaste aisle of a grocery store? Holy cow, it's overwhelming. There were so many different brands and so many different types of toothpaste. Should I buy a gum health toothpaste or a whitening toothpaste? Maybe I just need an all-around toothpaste. What about sensitivity? Should I be worried about enamel and get an enamel toothpaste? What about clean and freshen? I think my breath is pretty good. My wife doesn't complain, but maybe I need more of that. And then there's this category of future-proof. What is future-proof? Should I future-proof my teeth? These are like the major categories of toothpaste that Crest has on their website. Because I started to explore this. And if you exclude children's toothpaste, if you go to Crest's website, Crest is a big toothpaste manufacturer, they have 24 different types of toothpaste, all in these different categories. Well, that's just one manufacturer. If I go to CVS website and count up all the different brands of toothpaste, there's about 24 or 25. You got Arm & Hammer, you got Act, you got Aim, you got Burt's Bees. You have Crest, obviously, Colgate. I like this one. My Magic Mud is a brand of toothpaste. You got Oral Gel, Rembrandt, Sensodyne, on and on and on. I might have to check out My Magic Mud. I wonder how that works. Anyway, so if you have 24 types of toothpaste, and let's assume every brand has, there's 24 brands, let's say, and they all have roughly 24 varieties, and I know that's not the case. When you're standing in the toothpaste aisle, there's 576 options for you to choose from. See how hard it is to make a decision just when buying toothpaste? You just sort of grab what makes sense. Maybe the box with the best color or the one that you remember as a kid. That's where behavioral finance comes in. This is what we're dealing with when we try to make decisions in this modern world, well beyond toothpaste. Because what has happened is we have so much choice that we have what is called decision fatigue. We are required to make thousands and thousands of decisions every day. Do I wear flip-flops or do I wear tennis shoes? Do I wear loafers or penny loafers? On and on and on, we're forced to make decisions. And this is a syndrome actually coined by a social psychologist, Dr. Roy Baumeister, based on the Freudian hypothesis of ego depletion. The more decisions you make or have to make, the more it depletes your energy and your willpower. And so at the end of the day, you wind up on the couch eating Oreos just because you don't have any willpower to choose the carrots. You just don't. I've made too many decisions today. So what we rely on are some of the behavioral things that we talked about of just what we're used to, that anchoring. I'm just going to do what I always have done because it's too overwhelming to go to the toothpaste aisle or the investment aisle. I'm overwhelmed when I go there. Some people try to cut down on decision fatigue. I'll use myself as an example. I'm a creature of habit. So when I find a brand, like lately with shirts, it's been Untuckit. When I find a brand that I feel represents the style that I enjoy and fit well, that's all I buy. So if you look at my closet, my dress shirts are all Untuckit shirts. And if I buy a pair of pants that I like, I'll just buy every color of that pair of pants. When I take client notes, I have one notebook for client notes. I have another notebook for idea iteration. I have another notebook for my daily schedule. I do things exactly the same way and pre-decide. And I could probably think of a bunch of other areas in my life that I do that. And I don't do that. I do that because I like order, because I'm surrounded by chaos and uncertainty like you are. But it feels free. I never have to wonder what kind of shirt I'm going to put on. I just put on one of my Untuckit shirts. I do the same thing with shoes too. It's a little boring, but it helps. And most likely you have something like that as well. That's one way to battle decision fatigue. With investment, a good example here, professionally, from an investment management standpoint, when I would evaluate a lot of different investment strategies, I just made a rule. If it's going to be a core position, it has to, at the time, and it's expanded, it has to have a 10-year track record, lower than average fees, and a few other dynamics. And just by setting those rules, I cut out a ton of the noise of all the investment strategy sales pitches that didn't meet those requirements. So there are things we have to do because this decision fatigue is crazy. For toothpaste, my wife or son just go pick one. I don't care. But if I'm standing there looking at all of the 576 varieties, I'm fatigued already. And this is really important. I think that's why this series is important, because let's think about retirement. There are a lot of decisions to make. There's, when are you going to retire? Is it going to be full retirement or part retirement? Spending. What am I going to have to spend? Now I got to go make decisions about that. How am I going to create my paycheck? How am I going to protect against losing money early in retirement? How am I going to protect against inflation? What about taxes? Where am I going to get my money? How am I going to manage my taxes? What will I do each day? Who am I going to hang out with? What will motivate me? Where do I want to live? That could be type of home, neighborhood, area, state, atmosphere. on and on. And each one of these very high-level decisions opens up a decision tree that is massive, has massive roots underneath it of all the decisions that you face after making the initial decision. A good example. Where do I want to live? Okay, what type of home do I want to live in? There's one decision. You have condos, you have townhomes, you have duplexes, you have single family homes, you have apartments. You see how the decision tree the roots start to go crazy down? And then what about my neighborhood? You got urban, you got suburban, you got planned communities, you got communities out in the country. What about the area of the country I want to live in? The Northwest, the Pacific Northwest, the Midwest, the South, the Deep South, on and on. The state, the atmosphere that you want. You can see how just in this one decision of where do I want to live, you have these roots that expand of multiple decisions you have to make after that first decision. And it goes the same thing with your investment portfolio, how you're going to draw your paycheck, how you're going to manage taxes, and on and on and on. I'm fatigued again. Let's just take a moment. This is what we're facing every day. And the point of this is when you are approaching retirement, it's easy to ignore a lot of these decisions because you get this and you're overwhelmed and you just walk away from the aisle and tell somebody else to pick the toothpaste. Or you just do what you've always done because it's just easy and you don't want to get fatigued in dealing with it all. And so what ends up happening is you either keep on working or you leave work and you just stay with the structures of your investments and your choices that were built for a time that is a different season than the season of retirement, like we've talked about in terms of accumulation and decumulation and why you own the house that you own and et cetera. So it's easy just to walk away from these decisions and just keep doing what you're doing because you're fatigued. So the goal of this entire month is for you and I to have a framework to harness this, to focus on making lots of good incremental decisions so we don't get overwhelmed, because a lot of times we get overwhelmed on unimportant decisions. A relatively unimportant decision of buying the toothpaste is much more unimportant than whether I buy the Cheetos or the carrots, right? That's a more important decision. So if I spend 20 minutes in the toothpaste aisle trying to decide the toothpaste, I'm going to be so tired, I'm just going to grab the Cheetos. And so we want to make sure we harness this so we can focus on the right decisions, the ones that really impact your life. And we not worry so much about the smaller ones. And then once we do that, then we have to have a structure so you can go through the reasoned process to get to the result of the decision that really serves you best. And if we can move that dial just a little bit, if you can move that dial just a little bit, you can really rock retirement. I know you can because I've seen people do it. I've seen them in the club reassess the decision they made and make a choice that really has improved the quality of their life. And I've seen it with clients that I've worked with, and I've seen it in my life. So that's what we're going to do this entire month, is build out how do we actually do this? Because I don't want to just talk about it. I want us to have a framework to do it. I want you to have a framework to be able to do it so you can improve your life. So that's where we're going. And so at the end of this month, we're not going to be fatigued. We're going to be energized. But for now, let's go talk with a buddy of mine and answer some of your questions. So I know that it's August and Nicole is coming back from maternity leave. And actually, she's quasi coming back because of her young boys and school and everything else. She's going to come back as much as she needs to and still be able to manage all the young ones in her house. So for now, we're going to have a friend of mine, CHAD Smith from Financial Symmetry, who's just a really good guy, a certified financial planner. And they have a podcast, Financial Symmetry. You can check that out. And we're going to answer some of your questions. So let's chat with Chad. So as we begin this month, Nicole is still taking care of her family. It'll be interesting to see because she has 2 younger boys in elementary, middle schoolish, and little Dawson. And she's trying to figure out when they go back to school. So we've had some conversations. So I don't want to put any pressure on her to come back because I'm just that nice of a guy. No, she deserves it. It's a lot to take care of 3 kids. So I invited another financial advisor that I'm good buddies with, CHAD Smith. How you doing, buddy?
Doing great.
And you are part of Financial Symmetry.
Yes.
And you have a podcast by the same name on finances and retirement.
We do.
How's that going?
It's coming along now. I think we just hit episode 115. So 5 years in. Not a vet like you, but we learn from vets like you.
Are you weekly or how often do you do it?
Every other week.
Every other week. And so Financial Symmetry is about what? What do you make your show about?
So we focus mainly on retirement, but the kind of tagline is balancing today with retirement because we work with people in their 40s and through 60s and on, but we kind of first meet them generally when they're in that pre-retirement phase, when they're looking to make some better decisions about how to get things organized so that they are ready to retire.
Yeah, one thing I really like is that theme of balancing tomorrow and today is, I hear more people talking about it, which makes me happy.
Yes. Well, going through what we just went through with the pandemic, I think it can shine a spotlight on what's important today and then how you should be prepared for tomorrow, given something like that. It
does bring it to the forefront, doesn't it? And then the risk of that is, I think personally, because I remember this with 9/11, similarly, it brings that what's important to you to the forefront, right? Those really trigger events. And the danger is, well, it's an opportunity and a danger. The opportunity, I think, is to really make some decisions knowing what's important to you. It's like a window of opportunity where you have a lot more clarity of what you always say is, but it feels more intense. And then the risk is, as those events fade into the distance, that we just sort of go back to sometimes sacrificing our life for work or whatever.
Yeah, the cliche is it puts things into perspective, but we're here today to talk about making better decisions, right? So that those decisions can stick going forward.
Exactly. Because there's a compounding to decisions we make, isn't there?
Absolutely.
So let's answer some questions. All right.
Okay.
We got a few. This is Will, and it's on interest rate, risks, and alternatives. And one thing I like about our listeners, Chad, is when they ask questions, they give a lot of detail.
Yeah.
There's a lot, I've had paragraphs of perspective and context, which is amazing. But Will is essentially asking, as of this writing, the yield on Treasury is about 1.5% for a 30-year maturity, 0.2% or 20 basis points on the 3-year Treasury bill. And the Fed has already promised to keep interest rates low at least until 22. And those kind of promises are true until they're not. Mm-hmm. And when you're looking at the fixed income portion of your portfolio, say for the next 3 to 7 year time frame, wouldn't it make sense to have a high yield savings account, which are yielding, he puts 1.25% at the time he wrote it. I think they're around 1 now. Even in lieu of short-term bond funds, he mentioned a couple that are yielding, virtually 0, 0.14 and 1% one instance, and then a longer-term bond fund of 1.4. And so basically he's asking, given the choice, wouldn't it make more sense just to use these alternatives rather than a bond fund? Because even if interest rates rise modestly, the interest rate risk on the value of those vehicles would cause them to go down. Mm-hmm. What do you think about that?
Yeah, something many retirees, I'm sure,
we're all struggling with this. We had an hour conversation in the Rock Retirement Club trying to figure out answers. So I'll share some of the ideas. But
yeah, I think understanding the framework of your overall financial situation and when you need money is the key to this, right? So he put a time frame on it. You said of 3 to 7 years he was looking at, right? He's got this money and wants to maximize the return on that money for the 3 to 7 year period. But the first thing is to understand why you're investing in the first place and what is the purpose of this bucket, if you will, of your portfolio. Ideally, cash and or bond funds is to weather the volatility storm of stocks, right? Now, if you talk about these kind of decisions that he's mentioning here, from our perspective, no one knows what interest rates are going to do. If you recall, 2 years ago, there was a lot of calls that interest rates were going to shoot straight up, right? Because we had eclipsed 3% on the 10-year T-note at that time. Everybody thought, okay, this is going to be the rise that we've been waiting for. But there's long periods in history where interest rates stay low. It can either rise for a long period or fall for a long period, or it can stay kind of sideways for a long period of time. So trying to forecast where interest rates are going to go within the context of making a decision like this can be dangerous. Because if you were making this decision 5 or 6 years ago, because we were wrestling with these same questions 5 or 6 years ago.
I was wrestling with this question literally 20 years ago.
There you go. Yeah, it's a tough one. And I think you have to separate the emotional aspect and allow diversification to work for you. If you know you don't need the money for 3 to 7 years, is it okay to have it at risk in bond funds that historically have earned a higher rate of return than cash?
Well, if we look at last year, you look at a total return on a bond fund, and it did pretty well.
It did really well, right?
Because interest rates came down a little bit.
That's the fear, though, right? Because they're so low, people believe that it can't go lower, but who's to say they can't go negative?
So what do you think of the options of substituting a bond fund for a long-term CD or midterm CD or high-yield money market?
Yeah, you have to have the time, right? Because over the short run, anything can happen in bond funds. You could get a surprise interest rate spike. And if you do, that could hurt any bond fund. But the shorter the maturity on that bond fund, like you mentioned, the Vanguard short-term bond fund, for example, those will be impacted the least compared to a long-term bond fund, right? So you're trying to balance that aspect of when are you going to need this money? So if you know you have 3 to 7 years, you could diversify and take some risk in a bond fund, knowing that you may lose some and it not earn as much as the cash in the Ally or Capital One. But if you know you can't sleep at night, if you have that at risk in a bond fund over that 7-year time frame, cash probably should be the choice for you, right? So it comes down to that managing the emotional aspect. And people talk about hedging sometimes when they don't know how to make a decision. Sometimes I think making a decision journal actually around something like this can be helpful. Writing down why you're making the decision, how you think it may happen, and then what are you missing out on by making the decision, right? And then you can look back and evaluate how you felt at that time, and maybe it can give you some I've read before, intellectual humility, right? Where it's okay to admit you were wrong, but know why you were wrong and realize if it was emotional or if it was based in the data that you were looking at.
Yeah, and I think you have to be thoughtful about the decision. And so what I think, Will, is to what Chad said, what is the money for? So for us, we build pie cakes, right? So if we're pre-funding consumption, so you say 3 to 7 year time frame, if you're building that portfolio where in 4 years that allotment is going to be needed to pay for consumption, I probably wouldn't use a bond fund. Mm-hmm. I would use either individual bond or a CD or high yield money market. The risk with money markets, we've seen it. They've come down from 1.25 to, as you mentioned, to about 1 now. And there's nothing to say that they can't go lower. This is going to be scary to say. There's nothing to say that we in the US cannot go to negative interest rates, right? A lot of the world has been in negative interest rates. I'm not saying that we are, but ultimately our choice is a combination of a prediction of the future and a handicapping of what's my exposure. So I think of it this way. If you choose to go to a high yield money market or a CD, you're accepting the yield. And what your worst case scenario is interest rates go down further and your yield deteriorates and you miss out on the return of the funds, right? So that would be sort of sucky, but it wouldn't be devastating. When you look at, like you mentioned, the Vanguard short-term bond fund, and I don't typically talk about individual funds, and I have no opinion about this fund at all, but if we look at the characteristics, and I'm just looking at Morningstar, the yield on it, you say is 0.14% or 14 basis points. According to Morningstar, it looks a little higher than that. But the way you can gauge a fund in terms of interest rate risk, if that's really what you're concerned about, the effective duration is 1.89 years. So essentially what an effective duration is the average of all the cash flows in terms of the actual maturity of it if you factor in the cash flows. And the rule of thumb is if interest rates go up by 1% or move by 1%, your portfolio value will move up or down by the amount of the effective duration. So if the effective duration is 1 point, let's just call it 2%, so I can do the math easy. Yeah. If interest rates go up by 1% and the effective duration is 2 years, you would see the portfolio go down by 2%. So that's one way to gauge this. And I always like to answer, Chad, what exactly am I doing in my practice? So what do you do about this?
Yeah, we build financial plans and understand the cash flow that is needed. Like you mentioned, what annual cash flows are needed. And we actually use 7 years as our bucket of safety, so to speak. And that helps us decide how much should be in cash and or bonds or bond funds for that matter. Because we've seen this year and throughout the last 10 years with interest rates, the future really has an uncanny way of surprising in the short run. So if you know with certainty how much you will need over the next, reasonable certainty, right? You set targets in a financial plan of cash flows. Within retirement, a lot of times, we may see house upgrades immediately upon retiring. We used to see travel, not so much this year, new cars, maybe a second home. That's been actually one that we've seen a lot more recently because people are stuck at home and maybe they're looking for second homes now because they can't travel, and that's a safer way to do it. However, whatever those cash flows are, you total those up, and then you can make some decisions around what percentage you want in cash for the next 3 years or 5 years. And then you can have a little bit more of that in those shorter term maturity bond funds like Roger was talking about, where there's going to be less movement in the interest rates over that 7-year time frame. So that's how we make decisions around that in our allocations.
Yeah, and in an upcoming episode, we'll talk about essentially the same thing. We think in process, strategy, tactics. So this question is a tactical question. And when we're mapping out and building the income floor to cover consumption, we are using CDs. We're finding high yield money markets. In some cases, one thing we forget to look at, BW in our club reminded me of this the other day, are fixed annuities where you have a term where they'll pay you a specific rate of interest for 2 or 3 years, which generally are higher, but you have the complications of the wrapper. So you got to be careful about that. I-bonds. I'm using all of those things. Mm-hmm. I just wouldn't overthink it because at the end of the day, we want to be thoughtful about it, but this tactic is not going to have a significant impact on your life. And so we want to spend some time on it, but not too much time.
Well said.
Now, Melissa wanted to know, she said she listened to the recording of retirement plan live we did with Sam, which is a case study where you hear Sam and I walk through building a plan, and then we have a live results webinar. Mm-hmm. And so she listened to all the series, and she wants to know, well, how can I access the webinar? What was the result for Sam? Which is a good question. So Melissa, if you go to rogerwhitney.com/resources, we have replays of all the webinars that we've done. So hopefully that's helpful to you. Anybody else that listened to a retirement plan live? We need to do one of those again. Think about that. Maybe I'll do it on you, Chad. Nah, you're too young.
A lot of decisions to be made. Rebuilding my deck out here. Maybe you could help me with
you're
that.
Just a spender right now. It'd be too difficult.
Yeah.
Okay. Now, our next question is from Ty, and it's on something called a SWAN ETF. So first off, we do have to mention that he listens to a lot of financial planning and retirement podcasts, and mine is the best. So God bless you, Ty. God bless you. Okay.
I can't disagree with it. It is a good one.
So he's 53 and is contemplating early retirement. And he thought he knew his risk tolerance before COVID. No kidding. And he wanted to hear my thoughts on the SWAN ETF, which is basically an ETF based on an index that tries to protect against black swan events. So what a black swan event is, just sidebar, is one of those, Chad mentioned it, one of those unexpected extreme events or shocks that can hit a market, and you really can't predict them. And he wanted to know, well, he said he thinks it should be called the chicken fund because it's meant to protect those big down drops if you had them and still get a little bit of upside. And conceptually, it would feel safer having something that would actually do well when markets are really getting hammered. Are you familiar with this fund?
Yes. I had to look it up to understand the mechanics of it, but yes.
Okay. So essentially what it does, right, is it mainly owns treasuries, and then it buys long-term in-the-money options on the S&P 500. So it probably is a little complicated for some, but essentially it's almost all owning treasuries, and it's long in a leveraged way the stock market. And the idea is when markets go down, because you have the treasuries, which generally do well during turbulent times, it offsets or makes up for anything that's lost in the S&P 500. Did I explain that well, Chad?
Yeah. And it limits the downside on those call options too.
Yes, because they're in the money. Yeah. Right. You don't need to know the complications of it. But so what do you think of a strategy like that in a retirement plan?
So you could think of it as a individual stock in essence. Like it's an alternative asset class, right? So it's going to operate and act differently than much of the rest of your portfolio. And when we look at things like this, you can't have return without risk, right? That's a key element, Finance 101. And it's important to remember when you're looking at things like this, because often these can gain momentum in times of weakness or extremes, like we just went through with the pandemic. And all investors want the secret sauce, right? Problem is there isn't one. So what you can do from that point is look back historically and try to understand and ask questions. Well, when would this not do well, right? And you mentioned, Roger, that most of the time treasuries do or not correlated to stock investments, but every once in a while they both go down. And that would be a time where you would want to understand what environment has that happened in and when could it happen, because that could be a period where this doesn't do well. But again, this really comes back to what is your investment plan? Decide on that risk tolerance. If you want a little extra, if you want to take a risk and speculate some, because this is technically a speculation on what you feel like is going to happen in the markets, right? It did very well through this. I'm assuming that's why he's asking the question. It did well through the decline and did well last year because long-term bonds did well. But we would rather want to take our risk on the stock side of things versus long-term bonds because of the hard prediction, I'd argue impossible predictions of understanding interest rates, as we just discussed. It kind of reminds me of that example we used to use back in, I haven't used it in a while, is investments are like a bar of soap. Your money's like a bar of soap, right? And the more you handle it, the less you have. Often. So I think this could fall into that category a bit. But again, to each investor, if you want to take a small risk, we try to limit any individual position in a portfolio like that that's going to have more concentration risk in a specific area to 10% or less.
Yeah, here's the hard part, I think, Ty, is this is an alternative investment, right? Because it's a strategy that doesn't really have a definition. And so if you want me to define alternative investments for you, basically it's your junk drawer in the kitchen, right? There's long short funds, there's private equity funds, there's things like this, there's option strategies. It's just a big mess of stuff. So alternative investments really doesn't have, there's a lot of subsets under that. And I think it's a really interesting concept. And you mentioned that it follows an index that's been around a while, because this fund has been around for a year and a half or so. Mm-hmm. And a lot of times when you're building a investment product off of an index, where the risk becomes is in the execution and in the cash flow management of the vehicle itself, right? An index can do really well, but with something like this, they're buying options, they're buying treasuries, they have to deal with daily inflows and daily outflows. So a lot of times when you have an investment manager, whether it's an ETF or an open-end fund, their job is not simply to implement the investment strategy. Just like in your household, it's to manage cash flow. So when this is a small house in the sense it doesn't have a lot of liquidity, as you have people run into it, they got to get all that money invested in these more opaque things of leap options, long-term options. As people come in, they got to go buy. And then if people start selling it, they got to sell. So there are a lot of things that could potentially go wrong. The second part, I think, and you sort of mentioned it, Chad, of, strategies like this, limiting the size, right? Because of allocation. And I can't remember the name of the study, but the hard part with alternative investments, and I use some with my, higher net worth clients, is that there's talk about gold or this strategy. If you're a chicken, I'll use that name. If you're a chicken and you want to own something like this, well, if you buy 5% of it in your portfolio, when it all hits the fan, it's not a large enough position really to make any difference in your life, right? To have this fund have enough of an impact to keep the chicken happy you would have to have such a large percentage of your portfolio that ultimately it would drag the whole thing down during normal times, waiting for this black swan to happen. And so that's the hard part with alternatives. To really have the impact on the overall portfolio, you have to have a larger percentage than we're typically comfortable having. And then my only other comment, even with the alternatives that we've used, I don't look at anything without a 10-year track record. That saves a lot of time.
Well, that brings it back to having a discipline too, right? Around your investment strategy, having some rules in place, like your rule of not looking at anything without a 10-year track record. It's important in any investment strategy, because what we'll throw around the comment a lot that investment behavior matters or is a driver of returns much more than the investment selected.
Yeah. You know where I came up with that rule in my due diligence process?
Experience?
is over 25 years being a sucker for a great pitch and having all the data support it of a new strategy, because as an advisor, especially when I was less mature, you want to please clients and you're always looking for the edge, and just realizing and getting burned enough of, I'm just not even going to look at anything because that sounds great that doesn't have the actual track record. It just saves a lot of time.
Yeah. One other comment. I've seen this through the years with the equity indexed annuity idea, right? That you can participate in the upside, but are limited on the downside.
Yeah.
And it sounds great, but
I would much rather go organic. So when I think of investments, I want to eat food, not food product, as much as possible. Mm-hmm. And I would go with, back in January, I think we went through it, building the pie cake of, if you are getting ready to enter retirement, mapping out your consumption or consumption need for the next 5 years, and identifying how you're going to pre-fund that using CDs or ultra short-term bond funds or what have you. And then having the next layer be diversified, and then maybe a longer term that's more risky. If you go that route, you're going to inoculate yourself against a lot of the craziness. So hopefully that's helpful. Well, we have a bonus question, Chad, that I did not share with you.
I like it.
But I felt bad because I emailed Jane that I would answer the question, and somehow I didn't in the next month or so, and I didn't get it fit into my outlines, and I don't want to let Jane down. So
well, let's make Jane happy.
Okay. So I don't expect you to know the answer off the top of your head. So in December of 19, she did a direct transfer from one 401k to an IRA, right? So they reported it it's a direct rollover, sometimes they call it. So she got a 1099-R for a direct rollover. And she didn't take control of the funds because it was sent directly to the firm. So this was a trustee to trustee transfer, and she was wondering why it was a rollover and how do I account for that? And so first off, Jane, Chad, and I are not CPAs. So your CPA or even TurboTax, if you use TurboTax, will help you walk through it. But essentially, that 1099-R is reporting that happened, and all you need to do on your 1040 is report that it was rolled over, and it'll all just wash out.
Yeah.
Right. So that's pretty straightforward. So that you can account for.
We've actually seen letters from the IRS from clients in this situation. And it can take you time to put the documents together, but essentially the IRS can't see the 401k. They can't see the money landing in the 401k if you did a direct rollover into the 401k. So you just have to explain it with documentation, and it does work itself out.
Now, here's an interesting COVID question. And I'm actually executing this, Jane, right now with a client. So she took her required minimum distribution from an IRA in February of 2020, and she wants to return it to the IRA because of COVID and the rules that are allowing that. And when you return that RMD, it's considered a rollover. And so you have a 12-month rule, right? So you can only do one rollover in 12 months. And so she's wondering, does this direct rollover count as a rollover that would prohibit her from doing the rollover of getting their RMD back into the IRA? That is a great question.
Yeah.
What I have found in looking at the IRS is my understanding is there are no limit to how many direct transfers, and they sometimes call those direct rollovers, so the terms are confusing. You can execute as many of those as you want, and they don't impact your 12-month rule for doing direct rollovers. That 12-month rule comes down to when you take possession of the money, and then put it back in. That's where that 12-month rule. But I would definitely check with your CPA because I'm like a 90% confidence on that. I'm rarely at 100% unless you ask me what I'm wearing today because I can go look at it.
Always good to have a CPA once over on ideas like that or moves like that. But that does raise the importance of having advisors, a financial advisor and an accountant in your life, because COVID-related changes. I mean, we've had, I think, 2 or 3 major pieces of legislation in the last, 8 months?
Exactly. I'm working with our custodian to put an RMD back, Chad, and the custodian isn't quite clear on the process of how to do it. Yeah. So they have to make it up.
Yes.
And just as a little bit of plug here, these kind of questions and issues are what we talk about all the time in the Rock Retirement Club. It's a safe place to ask questions, and then the collective wisdom of the group and myself and my team can come in and try to answer them and help you find the information that you need. But I'm happy to answer it on the show.
Yeah, it's a wonderful resource to have there, the Rock Retirement Club. What's that safety of asking and getting some constructive criticism too, probably.
So Chad, what's going on this month in the Financial Symmetry podcast?
So we just did an episode on prediction hubris, actually. It's funny that you're going through decision-making topics now this month, because that's the idea where you make decisions and you're predicting what's going to happen and you know what's going to happen with your investments, right? But we gave 5 strategies that you can use, or a decision framework, essentially, that you can walk through to help with that prediction hubris. And then we just went over some retirement surprises that we'll often see in our latest episode. So those are 2 of the ideas and ways that you can be ready for those surprises. Again, because we're talking to those people, generally, they're in that pre-retirement phase, and ways that they can set up choices or decisions they're making to prepare them down the road.
Very cool. Very cool. I just had a chat with Annie Duke, who's coming out with a book, How to Decide. And we had an hour chat, which was amazing. And the interview is going to come out in September because her book comes out in September, and I'm not supposed to release the chat before the book comes out.
Sure.
But one interesting comment she made was, once you make a decision, your decision is essentially a prediction about the future, right? So you have to figure out how you handicap everything, because when you decide, that is your prediction. You've made your decision, and then it comes into optionality and how much you can pivot and everything else. Well, thanks for joining me, Chad.
Yeah, it's fun. Thanks for having me.
We are off to set a SMART sprint.
On your marks, get set.
And we're off to set a little 7-day goal to take a baby step to, rock retirement. Of course. So in the next 7 days, I suggest that you pre-make one decision for yourself. A good example is I pre-make the decision of the kind of shirts I'm going to wear. Maybe you pre-make a decision by laying out the clothes that you're going to wear the next day, the night before. So when you wake up, you don't have to make that decision. So think of something that you can pre-decide today. So we talk about the Rock Retirement Club a lot, and I just wanted to let you be aware that at the end of August, we will be raising the price by about $50 or so to $549 as an annual membership. And we're going to be doing a tour here before the end of the month so you can get an idea to evaluate it. And the reason we're doing this is because we're adding some benefits and tools that you can use. And we're excited about that. And so this will help with that. But if you lock in the price and join this month, you're locked in forever. So, and when we raise the price in the future, that wouldn't impact you. You'd be locked in forever. So go check that out at rockretirementclub.com. And we will talk to you next week. I hope you have a great week. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.